Yes, good evening. And our discussion today will be based on a unit known as financial reporting and analysis. And this is a unit which is covered in CPA, that is intermediate level. And in the intermediate level first, you need to know that in intermediate level under the certified public accountants, we have 6 units which are supposed to be covered in this level. One of it being what we call the financial reporting analysis. Another unit which is covered in this level, we have what we call the company law. Uh, Other than the company law, we have what we call the auditing and assurance. Then we have financial management, management accounting, and notwithstanding what we call the public finance and taxation. So those are some of the units which are covered in intermediate level. But our point of discussion today, we are going to base our discussion on what we call the financial reporting and analysis. And in financial reporting analysis, you as a runner, at the end of the semester, you need at least to understand the following. One is the account for various assets and liabilities. So in this financial reporting and analysis, we will be discussing what we call the accounts for various assets and liabilities. Also, you need to know how to prepare the financial statements, including what we call the published financial statements to various types of organization. That is, remember, in foundation level, we had discussed what we call the financial accounting. And in financial accounting, we had looked at various financial statements. Like, for example, we talked about the income statement. Also, we talked about the statement of financial position. Also, we talked about the cash flow statements. Also, those are the areas that most likely we based our discussion on. In this level, again, we are going to look at those financial statements. Also, we will learn about what we call the notes to the financial statements in this level. And also, we will look at what we call now the published financial statement, what we call the published financial statement. Remember, in foundation level, we just looked at what we call the statement, the financial statement. For example, we looked at what we call the income statement. And in this income statement, we just said that for you to arrive at what we call the profit, we normally take what we call number one, you take the revenue. Then from the revenue, you raise what we call, you take the revenue, then you raise what we call the cost of sales in this level. And the cost of sales here, we looked at what we call the opening inventory. Opening inventory. Then we talked about the purchases. Then from there we talked about, to make it much easier, we talked about the closing inventory. So therefore, in this case, we say that for you to get this cost of sales, you normally take the opening inventory, you add the purchases, and then you raise what we call the closing inventory. And this, when you accumulate the three, that is how you arrive at these, at what you call the cost of sale. For you to arrive at what we call the gross profit, for you to arrive at the gross profit in this case. But now, in this case, we are going to look at what we call the published published financial statements. Published financial statement. How do we present now this information that we have here? How do we present it in a published financial statement according to the International Accounting Standard 1? How are we supposed to present this information? For example, under published financial statement, you need just to look at the revenue, then you raise the cost of sale. So this cost of sale, this amount that you are supposed to get here, will be calculated somewhere else. Once you have calculated it somewhere else, then you will bring this figure the way it is, and then you put it here. What do I mean? What I'm trying to explain here is that under published financial statement, these are workings. These are workings. So now, when you are presenting a published financial statement, you are not supposed to show that there was an opening stock, there was purchases, and there was what? There was the closing inventory. What you just need to do is to do this as working and present it in the title known as the cost of sales. So in this case, that is what we are going to look at. Also, under the expenses, when we will be talking about the published financial statement, when you are presenting your income statement in published format, you will find that we have the revenue, then we have the cost of sales, then from there, when you take the revenue, you raise the cost of sale, you get the gross profit. Then from the gross profit, we are supposed to raise the expenses. And these expenses that we will be talking about in this case, they are classified again further into 3 categories. Remember, this is one of the expenses. Another expense that we will be talking about in this case is what we call the selling and distribution. Selling and distribution is one of the expenses that we will be talking about. So your work will be looking at those expenses and classifying them. Once you look at those expenses, you classify them according to this category. Does it fall under the selling and distribution, or does it fall under administration? Administration expenses. Also, we have what we call administration expenses. Other than the administration expenses, we have what we call the finance cost. You can either decide to call it finance cost, or you can call it the interest expense. Interest expenses. So what I'm trying to explain here is that in foundation level, you are supposed to put all those expenses. For example, we have the bad debts, we have the depreciation, we have, we can talk about stationery, we can talk about, for example, other than the stationery, we have other expenses like general expenses. You are supposed to put all of them as expenses. But here, when you are presenting those information under the published financial statement, you will be presenting them, you will look at expense, and then you classify that expense under these categories. That is the cost of sales, we have the selling and distribution, administration expenses, finance cost, interest expense, etc., etc. And once you have done this, you are supposed to subtract. So that whatever that you are going to arrive at this juncture is what we call the profit before tax. Then once you have the profit before tax, then you raise the tax for you to get the profit after tax. That is how, for example, you need to present the income statement under what we call the published financial statement. Other than that, under the published financial statement, we have said we have the income statement. Other than the income statement, under the published financial statement, also in this level, we are going to look at what we call the statement of financial position, statement of financial position. And this statement of financial position, this is how it is going to look at. For example, in your foundation level, when we were talking about the statement of financial position, for example, when we were talking about the assets, we said that these assets are categorized into two classes, whereby number A, we were talking about the non-current assets. And these non-current assets, under non-current assets, we were looking at, for example, we were talking about the land and buildings, we were talking about the equipment, we were talking about motor vehicle, we were talking about furnitures and fittings. But as per the published financial statement, that is International Accounting Standard 1, when we talk about land and building, when we talk about equipment, machineries, motor vehicle, etc., we are going to present it under one title, known as what we call the property, plant, and equipment. So here, what I'm trying to say is that when you will be showing the non-current assets, you are not going to show what we call the land and building. You are not going to show what we call the machinery, motor vehicle, equipment. You are going to accumulate them together, then come with a single figure, and that single item will be known as the property, plant, and equipment. That will be the value that we will be looking for. What we mean is that the figure for the land and building, plant and equipment will be calculated under the heading that you used to call it in the foundation level. We were calling it the property, plant, and equipment, property, plant, and equipment, what we call property, plant, and equipment movement schedule. We used to prepare the movement schedule, and now this movement schedule is the one that you are going to use so that you can come up with a total, and from the total, that total that you have calculated it in the workings again is the one that you are going to present here as a single item. So therefore, the next item that you are going to present under the non-current assets is what we call, we can talk about the financial assets. We have the financial assets. And these financial assets, we can talk about, for example, financial assets which are available for sale. Available for sale, financial asset is a long-term asset. Other than that, we can talk about investment property. Investment property. Also, investment property will follow under this category. And furthermore, we talk about what we call intangible assets. And under that is again foundation level. We had also looked at intangible assets under what we call International Accounting Standard 8. That is where we studied this, what we call the intangible assets. So these intangible assets will also fall under this category, like goodwill, we have patents, we have trademark, we have development cost, research and development cost, etc. Then from there, you go to number B. Remember, under assets, we have said they are classified into two. We have the non-current assets, and also we have what we call the current assets. So therefore, when we talk again about the current assets in this case, these current assets also, we will talk about the inventories. We have the inventories. Then, other than the inventories, we can talk about the trade receivables. Then, from the trade receivables, also we can talk about we can talk about the prepayments, and the prepayments in this case, we are talking about the expenses which have been prepaid, meaning it is your asset. Then other than that, we can talk about the cash. We can talk about the bank account, bank balance, and also we can talk about the cash in hand, those are some of the items which are classified under current assets. And if you can remember, again, this is what we had discussed in our financial accounting. That is the foundation level. What you can see, the only we have only a slight difference is when it comes to the property, plant, and equipment. And this property, plant, and equipment, we are going to look at it in details when we look at the International Accounting Standard 16. International Accounting Standard 16, we are going to elaborate it in details in this case. So that's about the current assets. Then from there, once we look at the assets, whereby we have the non-current assets and current assets, then we can look at what we call equity and liabilities. We have equity and liabilities, equity and liabilities, equity and liabilities. And for the case of the equity and liabilities, again, here we are going to discuss about the equity. And when we discuss about the equity, here we are going to look at number one, what we call the ordinary share capital. We have the ordinary share capital. Then from ordinary share capital, we have the retained, or before the retained earnings, we can talk about the share premium, in case we have the share premium. And also, we say that the share premium, this is an amount above the par value. That is what we said again in foundation level. It is that amount which you are going to sell a share, or where the share is sold at the market value, an amount which is above the par value. That amount which is above the par value is what we normally refer as what we call the share premium. Then from there we can talk about the retained earnings. Then from the retained earnings, we can talk about, we have, in case we have the general reserves, and also we can talk about the revaluation reserves. So under the equity, we are going to look at the ordinary share capital, share premium, retained earnings, general reserves, and maybe revaluation reserves, depending on the items that will be available on question per question basis. It is going to depend on the items which are available on question per question basis. Then how do you calculate this? These ordinary share capital, share premium, retained earnings, general reserves, and revaluation reserves can be presented in another statement known as the statement. And that is what I will be talking about. Number three is what I'm going to discuss shortly, what we call the statement of changes. Statement of changes in equity. It is presented under the statement of changes in equity. So therefore, when you will be preparing the statement of financial position, your work will be just to present these. And where are you going to confirm the figures? The figures will be confirmed from the statement of changes in equity. You would have already prepared that statement of changes in equity. Then from there, now we can look at non-current non-current liabilities. We have non-current liabilities. And for the non-current liabilities, here we normally talk about, for example, we can talk about the debentures. You may find examiner talking about the 10% debentures. 10% debentures. Also, we can talk about ordinary, what we call the bank loan. Other than the bank loan, we can talk about deferred tax. We can talk about the deferred tax liability in this case. Notwithstanding, we can talk about lease obligation, which is long-term, and the lease obligation, which is long-term. Also, we can talk about lease obligation, which is long-term, etc., etc. Then we have current liabilities. And remember, today we are not just going to take a lot of notes, because it is just the highlight of what we will be studying under the financial reporting and analysis. I'm just giving a highlight of what we will be covering in this case. So under the current liability, we will be looking at, for example, we have the trade payables. Then here we are going to talk about the accrued expenses. For example, let us say that you had the employees, and the employees, they were supposed to be paid, for example, 1 million. Let us talk about 1 million. If the employees were supposed to be paid 1 million, and then at the end of the year, you say, for example, these employees have been paid 500,000, it means that there is an amount which you have not paid these employees of 500,000. This amount which you have not paid the employees is what we refer as what we call accrued expense. Whatever that you have not paid at the end of the financial year will be classified under accrued expense. And it is a short-term liability, because at the end you are going to pay it. It is a short-term liability in this case. Then other than that, we can talk about bank overdraft. And when we talk about the bank overdraft in this case, this is where you find that, for example, a company has, for example, their balance in the account is below. And what does they do? The bank allows them to withdraw more than what they have in their bank account. So whereby you withdraw more than what you have in your bank account, meaning that your bank account is going to remain negative. And therefore, if your bank account is going to remain negative, that means that you withdrew more than what you had in that account. Therefore, we refer as the bank account. Then we will be looking at the current tax. What are you supposed to pay in this financial year? The estimate for the year, in case you have not paid any tax during that year. We call it the current tax. So that's just a short briefing on what we call the published financial statement. You need to understand them, the published financial statement. And I said that shortly, I'm supposed to discuss on the statement of changes in equity. When we will be looking at this topic into details, then at that juncture, you will be required maybe, for example, to take a lot of notes in this area, so that it can help you in when you will be doing the revision. So therefore, the statement of changes in equity, statement of changes in equity, statement of changes in equity. in most cases, what you should understand, when we talk about equity, this is a shareholders fund. Shareholders fund. The owners of the company. What does the owners own? The shareholders fund. And this shareholders fund, normally, this is how you prepare the statement of changes in equity. The equity, we normally start with the balance brought down. And this balance brought down, if we were to talk about the details here, the details, if we talk about the details, these details will entail, number one, we have the ordinary share capital. So we'll be talking about the ordinary share capital, ordinary share capital being one of them. Number two here, you can see we have the share premium. Share premium, for example, where you find that if, for example, the par value of the share, the par value of the share was shillings 10, but the shareholder or the market value, the share was issued at the market value to the shareholders. For example, it was issued at shillings 15. It means for every share issued to the shareholder, we have a cap premium here, an amount above the par value of 5 shillings in this case. So that is what we call the share premium. Other than the share premium, we have the retained earnings. Remember that at the end of the year, what you should note is that the shareholders are not going to issue. What you should note is that the shareholders are not going to issue, not the shareholders, but the management is not going to issue 100% as dividends. So therefore, there is something retro that they are going to retain in the company. Whatever that the profit which is going to remain in the company, that is what we refer as the retained earnings. Other than the retained earnings, we can talk about the general reserves, or we can talk about the revaluation reserve. So this revaluation reserve that we will be talking about is, for example, if the assets have been revalued. In case you revalue the assets, if the assets were revalued, for example, upwards, meaning that the asset, for example, let us say that the rand had costed shillings 100,000. Then it has been revalued upwards. And now this is the cost. And then we have the revalued amount of the rand again. In this case, the revalued of the rand again, for example, it is 150, meaning we have what we call the revaluation gain. This revaluation gain of the difference between the two, which is 50, the revaluation gain is normally taken to the revaluation reserve in this case. Then from there, you can get the totals. So you will be adding the total. You take the balance brought down of the ordinary share premium, retained earnings, revaluation reserve, you get the total. In case you find that you had no revaluation reserve, but you had revaluation gain, so you present it here, revaluation gain, meaning at the beginning of the year, there was no balance brought down. So therefore, you just take whatever that gain is, and you put it in its class. So then at the end, we can get the balance carried down. So these balances carried down that we will be getting here, the balances that we will be getting here, although I have summarized, I'm supposed to talk about the dividends. I'm supposed to talk about in case there was unrecognized, for example, bad debts. Also, they are supposed to reduce our retained earnings. I have just taken a brief or a small summary trying to explain what should happen, because furthermore, we are going to look at these in details. So you need to know, again, you need to understand about the published financial statement, and notwithstanding or not forgetting about the cash flows. For the cash flows, again, we looked at it in the foundation level. So therefore, I'm going to explain it into details when we reach that topic. Also, other than that, you need to understand about the account for specialized transactions. And which kind of specialized transactions are we going to talk about? The specialized transactions, which in this case that we will be discussing, for example, is revenue recognition. How do we recognize the revenue? Based basic application of revenue recognition principles, and also in this case, we are going to look at the hire purchase, not forgetting the consignment sales. Also, we have what we call construction contract and joint arrangement. In that case, we are going to look at what we call the specialized transaction. Other than the specialized transactions, also we are going to discuss about the prepare group financial statements. So after in this case, once you know how to prepare the published financial statements, it is going to be easy for you to prepare a group financial statement. A group financial statement is where you find that you have various companies. For example, when we talk about a group, this is a relationship. Is a relationship between the parent and the subsidiary. Relationship between the parent and the subsidiary. So a short briefing about the group. When we'll be discussing about the group, we are going to look at the group. This group, most cases, our energy will be into what we call the parent company, parent, or sometimes we call it the holding company. We are going to look at the holding company and also majorly the subsidiary. So when we talk about the parent company, is that company which controls another company or which control the equity shares of another company more than, for example, we can talk about more than 50%. That is what we call the parent company, or that company which control the interest or equity shares of another company in simple language. When we talk about the subsidiary, is that company whose equity interest is controlled by another company more than 50%. What do I mean? For example, if you had company A, then, and here we have a company B. Let us talk about the equity interest. We call it equity interest, or we can talk about the ordinary shares. If you find that A controls more than 50% of equity shares, for example, of B, that automatically qualifies A to be what we call the parent company, and B is the subsidiary. And when we talk about the group, this is the parent-subsidiary relationship, whereby now at this point, you are going to bring them together. In that case, when you are bringing the company together, this is what we call the consolidation. We call it the consolidation. Consolidation is whereby now in this case, you are bringing these companies together, meaning you are consolidating these companies. Again, we are going to discuss on this, whereby, again, other than the subsidiary, we will discuss on joint arrangement or joint venture, and also we look at the associate and the group when also we reach at that topic. Other than that, we are going to look at the analysis and interpret what we call the financial statement, how you are going to analyze and interpret what we call the financial statement. In this case, we are going to look at ratios. Also in ratios, we had discussed them in foundation level. Then other than ratios, we are going to look at what we call the common size approach, and also we look at comparative financial statements. Also, we look at what we call the trend analysis, whereby in this case, we will be looking at, we have the difference between the vertical common size analysis and also we can discuss on what we call the horizontal. Other than that, we will be looking at what we call the how do we apply the International Financial Reporting Standard, IFRS's, and International Public Sector Accounting Standard, IPSA's, in preparing the non-complex financial statements. Remember again, also in the foundation level, we had discussed on what we call the, in foundation level, we had discussed what we call the public sector. It is just a continuation of the public sector. Also, we had discussed the International Financial Reporting Standards. Also, in this case, in this level, it looks like a continuation. So therefore, those standards at least, you need to remember some of them. And also, as we are going to incorporate more in this level. Other than that, I think what you need to know is the topics that we are going to cover in financial reporting analysis. That was a short briefing about this area, but now we have the topics which are covered in financial reporting analysis. And some of the topics that we will be covering in the financial reporting and analysis, again, is a continuation of financial accounting. One of it being the accounting for the assets and liabilities. So this accounting for the assets and liabilities, again, we have covered it in the foundation level. And in foundation level, whatever that we covered is very relevant and very key in this topic. So some of the areas that now we are going to explain further are being what we call the investment property under International Accounting Standard 40, where we are going to look at the investment property. Investment property, the main agenda that you need to know is how do you measure the investment property. In this case, we normally say that the investment property can either be measured at cost or at fair value. And if there is fair value gains are always reported in what we call the other incomes. Those are some of the things that you need to know. Also, we are going to discuss on assets used in exploration for and evaluation of mineral resources. That is covered under IFRS 6. That is International Financial Reporting Standard 6. We are going to explain further into details this area. Also, we will look at non-current assets held for sale under IFRS 5, International Financial Reporting Standard 5, where we look at the non-current asset held for sale and discontinued operation. When we talk about the discontinued operation, this is where, for example, you have a branch and you feel like that branch is not profitable anymore, and therefore you decide to dispose that branch. Then, other than that, we are going to look at what we call the financial asset and financial liability. What do we mean by the financial asset and financial liability? Or in short, when we consolidate them, I mostly call it what we call the financial instrument. And when we talk about the financial instrument in this case, we normally say a financial instrument is a contract which gives rise to a financial asset to one party and a financial liability to another party. So how can you know that this is either a financial asset or a financial liability. For you to discover whether this is a financial asset or a financial liability, what you are supposed to do is to know, was the financial instrument purchased or issued? If it was issued, it becomes a financial liability. If it was purchased, it becomes a financial asset. And therefore, this financial asset is going to give us what we call the returns. We are going to enjoy the returns in this case. Then from there, other than that, other than that, we are going to also furthermore express about what we call the risks. And when we talk about the risks, this is where you find that you have one party. One party gives you asset to use for some period. And then when you use that asset for some period, you are going to pay some consideration. Those considerations which you will be giving out uh, when you use that asset, we call them lease rentals or yeah, lease rentals. So we have leases whereby we have the lessor. The lessor is that the owner of the asset. And then we have the lessee. The lessee is that person who is acquiring this asset. But now, in this case, at your level, we are going to exclude what we call lease and sell back. We are going to exclude, sorry, what we call the sell back. Not what we are going to exclude what we call the sell and lease back risk. Other than that, we look at the current and deferred tax under International Accounting Standard 12. That is the International Accounting Standard 12, where we will be talking about the income taxes. This is the topic which we were supposed to discuss today, but because I had not introduced the unit itself and I had not given further explanation, I feel it was necessary for us to do this introduction. Then other than that, we have the government grants. The government grants. For example, now you can hear some youths are going to correct what we call the NYOTA funds. These NYOTA funds, the government is, from the information that we have, it is a grant. And when we talk about the grant, this is an assistance. This is an assistance which is being offered. And therefore, in most cases, this assistance is not returned. But it helps people, or it helps the company to do what? It helps the company to generate some revenues. Then from there, we will be looking at provisions. Also, we look at the contingent liabilities and contingent asset. That is what we will be covering under assets and liability. Another topic that we will be covering, the first topic I have said, is that we are going to cover accounting for assets and liability. Another topic that we will be covering is what we call the accounting for specialized transaction. And under this accounting for specialized transaction, I have said that we are going to look at the revenue recognition. We look at the effects of changes in exchange rates, and also we look at the borrowing cost. The borrowing cost. For example, let us say you want to construct a road, and this road you want to use the borrowed funds. So from these borrowed funds, how are you going to calculate the borrowing cost? That is what we'll be looking under International Accounting Standard 23. Also, we look at the preparation. Another topic, topic number 3, we will be looking at preparation of the financial statement for different entities and transactions. These different entities and transactions, here we are going to look at the conversion of partnership into a limited company. For example, if you had started a business as a partnership and you find that this business now you want to change it into a limited company, how do you convert that business from being a partnership into a limited company? This is what we'll be looking at under this preparation of the financial statements for different entities and transactions. Also, we look at the professional firms. Professional firms like advocates. Also, we have the audit firm. Also, we have the accountancy firm, tax consultancy firms, medical practices. In this case, we are going to look at how do they prepare their financial statements. Other than that, we look at their agricultural activities and farming under International Accounting Standard 41 about how do you prepare the financial statements of a farmer. How do you prepare a financial statement of a farmer? Let us say, for example, we have a farmer who is dealing with the livestock. We have another a farmer, the same farmer is dealing with the crops. So how do you prepare those financial statements so that you can know the revenue that this farmer is getting from the business that he is engaging in? Then we look at the pension plan under International Accounting Standard 26. That is accounting and reporting by the retirement what? Benefit plans. Also, we look at the cooperative society under topic number 3. Then from there, the topic number 4 will be preparation of the published financial statement. And the most of our class today, I have taken time to explain about the published financial statement. So the published financial statement, this published financial statement, we will be looking at the presentation of the financial statements, like for example, the income statement. We have a statement of financial position, statement of cash flows, etc. In this case also, we are going to discuss what we call the accounting policies, changing in accounting estimates and errors. Also, we look at the events after the reporting period, and also, again, we look at discontinued operations. Then we look at the accounting and financial statements for the interest in other entities. For example, we talk about the subsidiary in this case, we talk about the associates, and also we talk about how do we treat the investment in subsidiary, associate, etc. And also, notwithstanding, we look at the branch. You can find, for example, you have a head office in Kisii. Then you have a branch in Nairobi, and maybe you have another branch in Mombasa. So how do you account for these branches? And remember, when we will be discussing on the branches, you will find that we have what we call the dependent branch and independent branch, what we call the autonomous branches in this case. We'll be looking also, we have the previously, we used to have also what we call the foreign branches, but nowadays we only discuss in this level only the local branches. So then we have the public sector. Under public sector, we look at the presentation of financial statements under IPSAS 1, then accounting policies, effect of changes in foreign exchange, revenue for exchange transactions, property, plant and equipment under IPSAS 17, intangible asset IPSAS 31, provision, contingent liability and contingent asset under IPSAS IPSAS what? Under IPSAS 19. Then we have the presentation of budget information in financial statement. That is under IPSAS 24. And finally, we look at analyzing the financial statements, where we look at the analyzing financial statements using, we have ratios covered in financial accounting. All those ratios that we covered in financial accounting, they are core because those ratios, we will be discussing them in financial reporting, and also we are going to discuss those ratios again in financial management. So you need to know all those ratios the way they are, because we are going to repeat them. We discuss them into details because we will be using them to analyze the financial statement. Then from there, we look at analyzing the financial statements using the common sense approach for the statement of profit and loss, and also we have the statement of financial position. How do we analyze? Using the common sense, where we have the vertical and horizontal. How are we going to analyze these financial statements? Those are the areas which we are going to look at into details as we see how we are going to cover these topic. So that is just a small briefing of how of what we are supposed to cover in the financial reporting and analysis. And then in our next class now, we will go direct to start tackling this unit so that we can finish it on time. And then we do some revision so that we prepare ourselves for the CASNEB exams, which will be on April. So therefore, I think I'm going to stop there. I'm going to stop there. So therefore, in our next lesson, now we'll be start discussing these topics. But what you should realize is that we are going to attack this topic randomly, meaning that we are not going to cover them the way I have mentioned them, topic per topic basis. No, we are just going to pick maybe subtopic, we do it, then we go to another topic, we do another subtopic until we conclude all the topics. And also the theory part, we have a lot of theories in this case also. We are going to share the notes in advance and then try as much as possible to discuss them. We discuss those notes and then we see what happens. So I think I'm going to stop there. What I'm going to do is to thank you for your time. The comments, in case there is any comment, maybe there was sound hitch, there was some echoes from somewhere, kindly let us know as we try to improve our system so that we can learn smoothly in this semester. So I will wait for your comment. Maybe the comment can come in our WhatsApp. Maybe, yeah, I think you can comment on WhatsApp. Then we see on the areas that we are going to improve. So thank you for your time. May God bless you. Let us meet in our next lesson.